Hello everyone, welcome to chapter 6. This chapter is going to be about dealing ranges, expansion swings, and how we're going to combine them with concepts such as market profiles and key levels. We're going to continue making and integrating these concepts together in logical framework that we've been doing since the first chapters of CPI. Explaining each of these concepts individually and explaining their intricacies is one thing, but then integrating all of these concepts together to create a proper logical framework is a different phenomena. You may have even learned about these concepts before, but I know you're still struggling with how you can actually integrate them all and create a proper framework. That's where you lack proper knowledge, and my objective is to fill that gap and to make sure you know how to actually integrate them and use it in your trading system. Now, other people don't talk about these things, maybe because they don't want to teach you the right things, right? But I doubt that's the case. I believe the reason they don't talk about these things is because they don't know about it, right? That's what I think is the case for majority of these so-called gurus. Now, let's get in the chapter. So, this chapter I'm going to explain everything that there exists about dealing ranges, right? So, first of all, we're going to start off with the definition of dealing range and what actually is a dealing range and how we can identify a dealing range. So basically, when price takes out both swing low and swing high, right, and has an expansion swing, that particular swing is considered a dealing range. Basically, when you see a move in the market where price takes out both opposing end of the ranges and takes out both sell side liquidity and buy side liquidity, and then it expands, that particular swing is considered a dealing range, right? You might be wondering what's the importance and significance of dealing ranges and why should we be familiar with dealing ranges, right? Right? Well, I'm going to delve on that later in this chapter, but first of all, you need to know how to correctly identify and find a dealing range on the higher time frame and how to correctly draw it out. Now, another thing about dealing ranges is that when you divide a dealing range to equal halves, it gives us a matrix. The upper half of that matrix is called the premium, and the lower half is considered a discount, right? Or the discount region. Then last but not least, the 50% of that dealing range is called equilibrium. This is basically how a dealing range looks and works. A dealing range is formed after price takes out both sides of a range and expands. And when that swing is divided into two halves, it gives us a dealing range with discount and premium regions, which we can potentially use for making better trading decisions, or they can assist us in our higher time frame analysis and thought process. Now, another thing about dealing ranges, right? Dealing ranges are similar to PDRA metrics, right? Or let's say it's a type of PDRA metrics, right? Now, it's not just a typical type, right? It's a specific type of a PDRA matrix which is for those type of swings which takes out both swing low and swing high, right? That's what we call a dealing range, and when it is divided into two halves with premium and discount, it gives us a whole framework on the higher time frame which we can use which we can integrate with market profiles on the lower time frame. Now I hope that part about dealing ranges is clear to you, and if it isn't, you can watch and listen to this again and it will clear your confusions. Now let's move over to the next slide and discuss dealing ranges in PDRA metrics. Now here on the screen you can see this range, right, with this line in the middle. This line right here in the middle represents the equilibrium or the midpoint of this range. And then above this midpoint we've got the premium region, and the lower half right here is our discount region. Now what you need to remember is that inside this dealing range or this PDRA matrix, we will have multiple key levels, right? And these key levels will be both in the premium region and the discount region. Now these key levels could be in the form of order blocks, breaker blocks, rejection blocks, fair value gaps, or maybe even in the form of highs and lows. Now this dealing range or PDRA matrix will be used to filter out key levels, right? And will be used to choose or select the correct key level based on market condition that we are in. For example, if we are in a bullish market, then our main priority or concern will be the key levels inside the discount region or near the equilibrium, rather than the key levels inside the whole range or inside the premium. Similarly, if the market structure in order flow is bearish, then our main focus would be on the key levels inside the premium regions instead of the ones that are in the discount. So now you can see that we've added a logical objective filter to the key levels that we're going to be dealing with. That's why it's called a dealing range. If we didn't have this filter or this PDRM matrix, then we would be selecting every random key level inside this range. But now thanks to this concept, we've added a filter and we've literally excluded half of the key levels based on PDRM matrix and based on the market conditions that we are dealing with. Now, the reason why we use this dealing range in PDRM matrix is pretty simple. It can be explained through market profiles. Now we know that according to market profiles, price never moves in a straight line up or down, right? Now based on that, we know that the way how price actually really moves is in ranges, expansions and retracement, right? Now with that in mind, we have to determine what is the correctly key level and how to correctly select a key level that we can match with these different market profiles on the lower time frames, and how we can actually measure and gauge the different retracement profiles on the higher time frame. And for us to in order to do that, we're going to use these dealing ranges and PDRA metrics, which will gives us a filter to weed out the unlikely and the lower probability conditions and scenarios, and we will be only left with the ones that are high probability. And our job as a trader is to stick with those scenarios and avoid the others. Now you're gonna have times where price will play out the lower probability scenarios, but your job is to not be intimidated by it, right? And be content with missing those moves and just following your plan no matter what. You should never be influenced by recency bias, right? That's a disaster for your trading and your analysis. If you're always after the new best thing and you always fall victim to the shiny object syndrome, right? Then you wouldn't be able to succeed in trading because you can't stick to one thing. That's why you need to have confidence in your system, and even if you miss moves, even if you lose trade, you must still have the confidence in your system and never let recency bias mess up with your head. That's the quality that separates the best traders from the losing ones. You must remember that at all times. Now, when I explain this whole chapter to you, you will have a proper filter and a proper logical framework in your hand, with which you will be able to catch high quality or high probability moves in the market. And if you consistently stick to those principles and those rules, right, with discipline, it's gonna completely change your trading. But there is a huge but. The thing is that you will also sometimes see moves in the markets where price will not respect a dealing range, right, and just breaks out of it without doing the right thing which is supposed to do, right? It's gonna do those things sometimes, right? And your job would be to classify those moves as lower probability moves and just let them play out without influencing your thoughts or your thought process, and just be content with missing them, because after all they are lower probability moves and your job is only to catch the ones that are high probability, right? And that gives you an edge over the markets, right? So that's how you will have to think about these things. I get many DMs from students saying, why did this not work, or why did I miss this move? And the plain and simple answer to that is basically how that's how the market moves. That's how the market works. You're gonna miss moves, you're gonna lose trades, but then at the same time, if you stick to the right things, you will also win trades, and those wins will make sure you end up profitable in the long term, right? That's what trading is all about. You should never adjust or change your system or influence your thoughts based on short-term results, right? Or small track record of data. You have to think in terms of the long horizon and be content with your system at all times, right? Hope that is crystal clear to you. Now let's move on to the next slide and let's discuss dealing ranges in a bullish market or in a bullish scenario. So here you can see we've got this range low and range high right here, right? You can clearly see what happened here is that first of all we took out the range low right? And then we went above to take out the range high, and then we closed above it. Now when this swing ends and stops, that gives us a dealing range right here. This whole range of price taking out the range low or the swing low and then taking out the range high gives us a dealing range, and when this is divided into two halves it gives us the premium and discount region. Now as I said before, the case study that we are analyzing here is in a bullish market condition, right? Which means that the structure is bullish or maybe the order flow is bullish, right? So now we're going to explain what price often does in such market condition when price forms this sort of dealing range. So right here with this expansion swing or when this swing ends, it forms this swing high. We know that according to market profiles, we're going to retrace, right, before moving higher again. Now let's say there are multiple key levels both in the upper region and in the lower region, right? Meaning both in the premium and the discount region. Now you're going to be confused with whether which key level to choose and whether what's going to happen at each key level on the lower time frame. Now in order to clear those confusion and be more familiar with the market dynamics, we're going to use this dealing range and PDRA matrix, right, and divide this range into two halves with discount and premium, which also means that now the key levels have also been classified into two groups. So we've got the discount key levels, meaning the key levels that are in the discount region, and then the premium key levels which are in the upper half of this dealing range. Now based on that, if you're on a bullish market, our main focus and our main concern is going to be the key levels that lies in the discount region, because the market makers or the algo or whoever the fuck is moving the markets prefers to retrace price to the discount or the equilibrium of this whole dealing range to buy at a cheaper price before moving higher or continuing higher. That's how price usually moves. Similarly, in a case of a bearish market condition or bearish order flow, the algo or the market maker tends to retrace price to a premium region or to a key level inside the premium or near the equilibrium before moving lower, because they want to sell at an expensive or a premium price that will offer them more profits, right? Because their main objective is profits. And that's the basic analogy and thought process behind it, right? Now it doesn't matter who moves the market or who does this stuff, but what you need to be familiar with is why it does it and that it does actually happen. And if you are familiar with it, you can then exploit this and turn it to an edge for yourself over the markets, right? So let's sum it up again. In a bullish market condition, after a swing ends, price usually tends to retrace price to a discount key level before moving higher or expanding higher again. That's what happens. Now let's move on to our dealing range for bearish market conditions, right? So in case of a bearish dealing range, price will tend to retrace price to a premium key level or to the equilibrium of this whole dealing range before moving lower, as you can see in the graphics. That's what happens in a bearish market condition or inside a bearish dealing range. Now let's further discuss how we're going to combine and integrate dealing ranges with market profiles in key levels, right? So first of all, in order to do that, we're going to use the correct time frame alignment and use them all in a proper manner. You must watch the chapters before this to be familiar with the integration of market profiles in key levels and also the correct combination of time frame alignment and how time frame alignment is used, right? You must be familiar with that. So for integrating dealing ranges and market profiles, first of all, we'll use time frame alignment. Right? So the way how it'll work is that you're going to use the higher time frame for your trading style, and that will be used for identifying and selecting the dealing ranges or the expansion swings, and then you'll have a lower time frame which will be used for profiling or market profiles, right? Let me say it again. You will have a higher time frame for dealing ranges or selecting dealing ranges and finding key levels, and then a lower time frame for market profiles and profiling the markets or profiling the price movements, right? These will be the two main time frames you're going to use to properly integrate these concepts together, and you can use the time frame selections for it, right? That's how you're going to use them. Remember that, right? Now you might be wondering what's the importance of dealing range and PDRM metrics and how it can assist us in our analysis and in our trading, right? So here is the list of some of the things that dealing ranges and PDRM metrics will help us with, right? So first of all, the most important of all, dealing ranges are used as a filter, right? It will be used for filtering out key levels, right, and market profiles. Similarly, dealing ranges would be used to build a higher time frame narrative for your analysis, and you could use it to assist you in filtering your drawn liquidity and your buys. Dealing ranges are used to filter out your targets, right? You could even use it for that purpose as well. You will learn how you're going to do this in the later part of this chapter, but you must remember that you could use it for this purpose as well. Then last but not least, it will also be used for managing risk based on filtering, right? These are some of the things that dealing ranges will help you with, right? Let's move on to the next slide. So here we're going to discuss different case scenarios for dealing ranges and market profiles, right? The first one we've got here is the different scenarios for bullish order flow, bullish market conditions, or when the drawn liquidity is high, right? So first one we've got here is when the market condition is bullish and price forms a bullish dealing range, and then price on the higher time frame retrace back to a premium key level, right? With a lower time frame expansion, right? Here it again. Price on the higher time frame retrace back to a premium key level with a lower time frame expansion, right? In such scenario, the possible outcome for price would be a retracement profile on the lower time frame, not on the higher time frame, but a retracement profile on the lower time frame. That's what you will expect in this scenario. Similarly, another scenario is when price on the higher time frame retrace back to a discount key level inside a higher time frame bullish dealing range with a lower time frame expansion profile, right? And in that case, the possible outcome for price and the most likely outcome for price is a reversal on the lower time frame and an expansion on the higher time frame towards the drawn liquidity, right? Remember, lower time frame reversals and a higher time frame expansion, right? You need to look at it with a dynamic top down perspective, right? You should be able to look at it with a dynamic perspective. Now let's look at some graphical representation of the different scenarios, right, that we've got. So considering the drawn liquidity is bullish and the market condition is bullish, and we're combining it with this higher time frame dealing range and the lower time frame market profiles. As I said before, it will be based on time frame elements, right? So here you can see that we've got this high and this low right here. And what happens is that first we take out the low, right, and then we take out the swing high right here. Now with these two purges we form this dealing range, right? Now dividing this whole range into two halves gives us a discount and a premium, right? And there are different key levels inside of this whole range, right? Both in the discount and the premium, and these key levels inside both regions will be classified accordingly. Now remember what I told you before about market profiles and dealing ranges, right? So once this swing high ends right here, you can see that price will then have to retrace on the higher time frame to a key level, and then we will see how it reacts to that different key level inside both the premium and the discount on the lower time frame in case of a bullish market condition. One thing you must remember is that these key levels are on the higher time frame, right? Just as the dealing ranges are on the higher time frame. But the market profiles that we will discuss and that we will be discussing would be on the lower time frame. So don't confuse the two between, right? Don't confuse both of them with each other. One is on the higher time frame and the other one is on the lower time frame. This whole dealing range and key level we are seeing, and this whole dealing range and key levels that we are seeing are on the higher time frame, where these profiles that you are seeing right here are a representation on the lower time frame, not on the higher time frame, but rather on the lower time frame, right? We are seeing what's happening on the lower time frame, right? I've just made it simple and plain for you on this graphical representation. Now you must remember that you must remember this while going through this chapter, right? So it doesn't confuse you at all. So now on the screen you can see this blue line, right? This blue line is representing a key level. Now this key level could either be in the form of a breaker block or any different key level, right? That doesn't make a difference, right? You just need to remember that this blue line right here represents a key level on the higher time frame. And also along with that, this key level, you can see that it's in the premium region, it's in the upper half of this region. Now, based on what I told you before, in a bullish market, price usually tends to retrace to a discount key level before moving higher. But in this case, we've only retraced back to a key level in the premium region on the higher time frame, right? So based on this, we are only gonna expect a retracement on the lower time frame, right? And not a reversal, right? Not a reversal on the lower time frame or an expansion on the higher time frame, right? Because we still have yet to retrace to a discount key level before we can move higher. Now there's going to be times where price expands straight away without testing a discount key level, right? But that's not a matter for us. What we need to remember is that more often than not, price will tend to definitely retrace to a discount, and that's what should matter to you. So let's see it again. We have this expansion on the lower time frame towards this key level, right? And which is in the premium region. And now based on the combination of this, the most likely outcome for price is a retracement, not a reversal, but a retracement. Now if you remember the first few chapter, you would remember that I told you that when expansion profile test a key level, the most likely outcome for price will be a reversal. But in this case, we've taken it further and we've made it more advanced. Now even with a key level, we're just going to expect a retracement instead of a reversal, because we've combined it with higher time frame dealing ranges and higher time frame premium and discount, which have given us further filter to our understanding of price movements and markets, right? So you can see we've added a more advanced filter to it, and you're building an advanced narrative, because first you would have expected a reversal and price might have stopped you out, but now you would only expect a retracement, right? So then you could manage your risk appropriately on any trade in the key level that are in the premium region in case of a bullish market condition, and you could be a bit more cautious with your trades in such market conditions, right? So let's move on. Here you can see on the charts the most likely outcome of price, what price is going to most likely do after it tests a key level inside the premium. So here you can see that even with bullish order flow and bullish market structure, price tested a bullish key level, but it only offered a retracement at the lower time frame, and then on the lower time frame price expanded lower again towards a higher time frame discount key level, right? And then it expanded from there. Now for most of you, this would be a really important answer to most of your questions, right? I've received hundreds of DMs asking me why this particular key level only offered a small movement, and why did this key level worked, right? And this one didn't. And this right here is the answer to that question. You might have chosen the wrong range, or you might have chosen the wrong key levels, and maybe you didn't know about dealing ranges and premium and discount key levels, and maybe you were choosing the wrong key levels, right? That could be the problem for you. And now you've learned about dealing ranges, right? And now you know about how you're going to correctly identify and select a key level, and how you're going to be cautious around different key levels inside residing inside premium and discount based on market condition, right? Now you know about this, and now you can use it as a filter, and you can use it to build a narrative, right? Now you've learned about it. So let's say another time you are dealing with a bullish market structure, and you've seen a bullish dealing range, and you've got a key level inside the premium. Now you're going to be cautious around that key level, because you know that price is most likely going to retrace price to a discount key level before it could move higher. But we also had this premium key level, so you're going to be wondering what's going to price do in this key level, right? So when you see that price has offered this movement, you're going to regard that movement as a retracement instead of a reversal, and you'd be cautious, and you'd know that the most likely scenario for price is now to go over that retracement, right, and expand lower again before it could move higher, because price still has yet to test a discount key level, right? you're going to be cautious about that. So you should keep this in mind. Now, you can trade the key levels in the premium too, but remember they're going to be lower probability trades, right? You have to be extremely cautious when trading them and not fumble, right? And for the most of you, it will be best if you avoid them, right? And only trade the ones that are in discount in case of a bearish, in case of a bullish, sorry, in case of a bullish dealing range or bullish market conditions. Now, after retracement right here, you can see that price expanded lower again, and then with this expansion, it tested the equilibrium and went into the discount region and tested a discount key level. And after that, the most likely outcome is a reversal and price reverse from there on the lower time frame, and that reversal on the lower time frame is gonna be an expansion on the higher time frame. You need to remember that this whole price action regarding market profiles is a retracement on the higher time frame, but right, but on the lower time frame it's been divided into these multiple market profiles, right? So you must remember that and not be confused by it, right? Now let's move on to another slide. So here we got the second scenario in case of a bullish draw and bullish order flow, right? Now what's gonna happen and what's gonna happen when they are combined with dealing ranges in lower time frame market profiles. So right here you can see that on the lower time frame we straight away expanded lower to a discount to the discount region and tested a discount key level. Now this key level, as I said before, could either be in the form of an order block or a breaker block, an FEG, whatever, right? That doesn't make that big of a difference. What you need to remember is that it's a discount key level. So in this case, price has done its retracement and it has now rebalanced the whole range, right? It has rebalanced this dealing range and now it can have a reversal profile in the lower time frame straight away, which will be a higher time frame expansion, right? So now based on market profile, we know that when expansion profile tests a key level inside the discount region, it leads to a reversal profile, and that's exactly what would happen, right? And that's exactly what happened right here. Now let's move on to another slide now, right? So here we'll discuss the different scenarios and combinations for bearish market conditions, right? Or when the higher time frame drawn liquidity or the higher time frame order flow is bearish. So first of all, here we got the first combination, right? When price reaches a higher time frame discount key level inside the higher time frame dealing range with a lower time frame expansion, right? And a bearish dealing range. So in that case, the most likely outcome will be a retracement on the lower time frame. Similarly, the second scenario is when price reaches a higher time frame premium key level inside a higher time frame dealing range with a lower time frame expansion profile. And then in that case, the most likely outcome will be a lower time frame reversal, which is going to look like a higher time frame expansion. So you can see clearly again we are adding filters further in the bearish scenario as well, right? Now let's move on to the next slide and let's discuss its graphical representation and how will it look, right? So here again you can see that we've got this range high and range low. Price took out the range high and then expanded lower to take out the range low and broke below it. And once this swing ends right here, we'll have this dealing range with two halves that discount in the premium, right? That's the basic framework of it. Now in this case, we're in a bearish market condition, so our main focus would be on the premium key levels, because in a bearish order flow, price tend to drive price higher to a premium key level before it could continue its journey lower. So right here you can see that we've got this dealing range, and what happens is that at the lower time frame we retrace higher to a discount key level, right? Which basically means a key level inside the lower half of the dealing range, right? So in this case, we will only have a retracement even though it tested a key level on the higher time frame, right? And we will not expect a reversal profile because we still have yet to test a premium key level before having a proper reversal on the lower time frame. Now you can still trade, as I said before, you can still trade this lower time frame retracement off of this discount key level, but you got to be cautious around it and manage your risk accordingly on such setup because they tend to be lower probability setups. And make sure to take profits early because price can in any time expand on you and take you out of the trade. And for the beginners in the intermediates, you should just avoid them at all cost, right? You should just not trade them at all, and that would serve you well. Then right here you can see that what happened is that after the retracement, we had another lower time frame expansion higher, which went higher to test the premium region and equilibrium. And now it can reverse from here properly, because now the range or the dealing range has been properly rebalanced, and now the market can continue its journey lower, right? You need to remember that. Now another scenario we can have in a bearish market condition is when price has a lower time frame expansion straight away to a higher time frame premium key level inside a higher time frame bearish dealing range, right? Then in that case we'll have a reversal, in a proper reversal, which will look like an expansion on the higher time frame, because now we've properly rebalanced the range and we can continue going lower. Now I want to make it clear again that the market profiling that we are doing right here will be done on the lower time frame, whereas the dealing range and the key levels will be chosen on the higher time frame, right? You need to remember that market profiling done on the lower time frame, and key level and dealing ranges chosen on the higher time frame. You must remember that, and you must use the correct time frame alignment and in the correct manner, right? Now I have explained all the different scenarios we can have based on the integration of dealing ranges and market profiles and key levels, and you've seen all of the highly likely and high probability scenarios and how you can use them as filters in your trading, and how you can use them to assist you in your high time frame analysis and your lower time frame thought process, right? Now you need to remember that you're also going to have times where price plays out the lower probability scenarios, but as I said before, you got to be content with missing them, and that shouldn't influence you at all. Your job as a trader is to just catch the high probability moves and filter out the lower probability ones, right? Now let's move on to the next slide. So right here we've got the three main advantages or the three main aspects of dealing ranges, right? And what they are used for. I've already explained them to you, but let me explain them to you once again, because we know that repetition teaches the donkey. So yeah, there's that, right? So first of all, the first significance of the dealing range is that when it's properly combined with market profiles and key levels in the correct time frame alignment, it will help you build a proper narrative both on the higher time frame and the lower time frame, and then you can use that narrative to properly position yourself on either side of the markets inside a CRT, right? That's what the purpose of this whole chapter is. The second aspect of the dealing range is that they are used as a filters, right? They are used as a filters for weeding out and filtering out the lower probability scenarios or the low quality scenarios, and only ending up with the ones that are highly likely and high probability in nature. Now remember the first few chapters about market profiles, and those chapters I taught you that when expansion profile tests a key level, the next likely profile is going to be a reversal profile. But now in this chapter you've learned and you saw that if you integrate dealing ranges with it, then that's not always the case, because you can also have a retracement too, and you'll have to look at the discount and premium levels before deciding whether we will have a retracement or an actual reversal profile on the lower time frame, right? That's what we call filtering, and that's what dealing ranges are mostly used for. The third aspect of dealing range is that it can be used for determining and refining your drawn liquidity, right? Let me tell you how. For example, if we are in a bullish market condition, if we've got a bullish dealing range, right? Now we know that in bullish market condition, price will tend to retrace price to a discount key level before moving higher, right? So with that fact in mind, when this swing ends right here and price start retracing to a discount key level on the higher time frame, your drawn liquidity on the lower time frame will be a discount key level or the equilibrium of this whole dealing range until price reaches the discount region in the equilibrium, and then you can trade towards the higher time frame drawn liquidity, right? And you can in the same way you can use this same concept for bearish market conditions too. Now let's move on to another slide. So here we got some important points regarding dealing ranges that you must be aware of, right? And the first one is that you should only trade the retracement and the reversal profiles on the lower time frame only after a lower time frame confirmation, and that confirmation could be in the form of a CSD or a change in the state of delivery, right? You must only trade those reversal and retracement profiles on the lower time frame only after a confirmation happens, right? You should never trade them before the confirmation. That's what you should stick to. If there is no CSD, then you shouldn't be trading it. A lower time frame confirmation in the form of a CSD gives you more conviction in your analysis and increases the probability, right? Now, the second point is that you should avoid trading the counter expansions followed by the retracement. For example, if we are in a bullish dealing range, and let's say we react to a premium key level and we have a retracement. Now we know that the most highly likely scenario for price is going to be uh, another expansion lower towards a discount key level before moving high, right? So the talking point here is that you should avoid trading that particular counter expansion because they tend to be lower probability, and you should rather trade the reversals followed after that expansions. Now you need to remember these points when analyzing price action with dealing ranges, and that way you will stay one step ahead and you'll be analyzing everything with a logical framework which I've given you in this chapter. Now let's discuss some example of higher time frame dealing ranges and its integration with lower time frame market profiles. So right here you can see that we've got this range low and this range high, or you could say swing low or swing high, right? You could call it whatever the fuck you like or whatever you want, right? Now you can see price with this particular swing took out both swing points and formed this dealing range right here. Now when we divide this whole range into two halves, we get the discount region and the premium region with their respective key levels, right? Now this is a bullish dealing range and our drawn liquidity is higher, so we're going to use the the bullish framework here, and we're going to see how we will analyze and dissect this price action. So first of all, here you can see that we've got this FEG right here in the premium region, right? And then we got the consequent encroachment or the midpoint of this FEG, which is below the equilibrium inside the discount region. So based on what we've learned in this chapter so far, when we are looking at this dealing range and price retrace to this premium key level in the form of this FEG, we're only going to expect a retracement market profile on the lower time frame instead of a reversal profile, right? That's what you're going to expect. But if it retraces down to the midpoint of this FEG, which lies inside the discount region, then you will expect a reversal from there. So first we've got the premium key level, which is the high of this FEG, and it lies inside the premium. That's why it's a premium key level, right? So if price tested, our expectation will be a retracement and not a reversal on the lower time frame, right? But if price tests the midpoint of this FEG, which is a discount key level on its own, then price would have a reversal profile on the lower time frame. And from there, because now the bullish dealing range has been rebalanced, right, and we've tested a discount key level and the range has been rebalanced, and now price can continue its journey higher. Now let's look at how this price action would look on the lower time frame with a market profiles perspective, right? So right here on the lower time frame, you can see that we expanded lower to the premium key level here, but it only offered a retracement, right? Because it was only a premium key level and the range has not yet been rebalanced. So that's why you can see that after this retracement, price then expanded lower again towards this discount key level, and once it tested this discount key level, it then reversed from there and had this reversal profile. And this reversal profile will look like a higher time frame expansion. All of this price section right here to the left will be looked at as a retracement on the higher time frame, and this reversal profile would be looked at as an expansion, right? So you can see that the dealing range was finally rebalanced and price tested a discount key level in a bullish market structure in a bullish dealing range, and now it can reverse from here and continue its journey higher, right? This was the first example. So here we got another example of dealing range and its integration with market profiles and key levels. Now again you can see the same framework for dealing range and the different key levels inside the discount and premium region. Now this one right here is a bearish dealing range, right? So we would be using a bearish framework for this instead of the bullish one. So what you can see here is that first we got this bearish FEG in the discount region, and then we got this order block right here in the premium region, which perfectly aligns with this equilibrium of this dealing range. Now when price retraces above and tests this FEG in the discount region, right? The most this discount key level will be able to offer is just a small retracement, but then price would expand higher again on the lower time frame to go and test the higher time frame key level in the form of this order block, right? And then once it tests that order block, it will rebalance the whole range, and then it will move lower again and continue its bearish journey. So our main focus in this bearish dealing range would be the premium key levels, and we would ignore the discount key levels. Now let's look at how it would look on the lower time frame with market profiles and how we could have gauged this info. Now right here on the lower time frame, you can see that price straight away had this expansion to the premium order block, right? So inside the dealing range, the range has now been rebalanced by testing the premium region and also by testing a key level inside the premium. So now the most likely scenario for price here is to reverse from there, because now an expansion profile is tested a key level, and the most likely outcome is going to be a reversal profile in the lower time frame, and which is going to look like a high time frame expansion. And you can see that this is exactly what happened here. Now let's move on. Here we got another example of a bearish dealing range, right? You can see that we've got the same framework for the dealing range with premium and discount key levels, right, of their own. Here in the discount, we've got this key level in the form of this high right here, and then in the premium, we've got this premium breaker block, right? Bearish breaker block inside the premium region. Now, based on what we've learned so far, the discount key level will only able to offer a retracement on the lower time frame, and the premium key level will be able to offer a complete reversal on the lower time frame and an expansion on the higher time frame. Here you can see price went above to the premium region and tested a bearish premium breaker, and then it expanded from there on the higher time frame because it rebalanced the whole dealing range. Now this is how it would look on the lower time frame with market profiles. So you can see price took out first of all the discount key level in the form of this high right here, but you can see it only offered this retracement, but then price expanded above again and tested the breaker block, the premium breaker block key level on the higher time frame, and from there price reversed and exploded to the downside. This is exactly how you can catch expansions on the higher time frame and reversals on the lower time frame. These are the exact same concepts you're going to use in a logical framework to catch expansions or reversals, right? Now here are some of the important points regarding dealing ranges. Now the first one is that dealing ranges are mostly used to build a narrative, right? Once you build a narrative and all the different concepts are aligned with each other, you can then start looking for CRT towards the down liquidity and position yourself and trades on the lower time frame, right? Another point is that apart from dealing ranges, you can apply the same concept for expansion swings and typical ranges, right? We will delve on this in later chapters, but you need to remember that you can apply the same concept for those type of stuff too, right? Another thing you need to remember is this is just the price aspect of the markets, right? We haven't even yet discussed the time aspect, so keep that in mind. And later levels of CPI, we will discuss time and price together, which will completely change how you look at the markets, and it will completely change your trading, right? But first of all, as I said before, you must build your fundamental understanding and your understanding of price action with this logical framework and look at it with this refined perspective. Now, another important thing about this concept is that dealing ranges only makes up like a quarter of the market movements, right? Most of the time, price is either in a range or inside expansion swings. So when you go over your charts, you can apply all these same concept to expansion swings and ranges too, and not just dealing ranges, right? But expansion swing and typical ranges too. Dealing ranges are just the advanced and the high probability versions of this whole framework, right? This logical framework. You must use the correct time frame alignment when using this framework, otherwise it won't work accurately, right? Now let's move on to another slide. Here we got dealing ranges and expansion swings, right? Now the difference between the two is pretty clear. A dealing range takes both sides, takes out both sell side liquidity and buy side liquidity in the form of range high and range low, and then it forms this swing right here, and when this swing is divided into two halves, it gives us a dealing range. But on the other hand, an expansion swings forms after a dealing range, and it only breaks above one side of the range instead of two. That's the difference between expansion swings and dealing ranges. This is how dealing range and expansion swing basically look in a nutshell. Now, as I said before, you can apply the same concepts for both of them, right? You need to remember that.